How to predict long-term stock investment returns. All right, we're going to use my man John Bogle's book, Common Sense on Mutual Funds, which I have signed by the good man himself. And you don't have a signed copy. Things to be used. Good to be me. Bonds are easy, my friends. Bonds, you just look at your current yield, and that's what you're going to get, with basically 90 to 95% probability. Bonds are simple. Stocks are different. And so we're going to go back to John Bogle, the founder of Vanguard, by the way, who I met when I was working at Vanguard in 1998 or 2000. And we're going to share with you exactly what happens. Simple. So from Bogle's page 34, while the long-term performance of portfolios is unpredictable, a careful examination of the past returns can help establish some probabilities about the prospective parameters of return, offering intelligent investors a basis for rational expectations about future returns. All right, let's see. As it turns out, equity markets have certain seemingly eternal characteristics. As the time frame increases from a single year to 25-year period, the powerful short-term influence of speculation recedes, and investment returns conform much more closely, if not precisely, to the investment fundamentals, dividend yields, and earnings growth. Together, these two elements constitute the driving force for stock returns. And from 1871 on, the first year of a careful study conducted by the Cowles Commission during the 1930s, we can trace the impact of these two fundamentals with some considerable accuracy. Why have stocks provided long-term real returns, real net of inflation, of about 7%? Answer: almost entirely because of the rising earnings and dividends of U.S. corporations. The sum of the real dividend yields and earnings growth generated from 1871 to 1997, adjusted for inflation, equals 6.7 in real returns. And what the real returns have been? 7%. So dividend yield plus earnings growth year over year, 6.7. The 7% is what the stocks actually did. That means you got 30 basis points, 0.3%. from speculation or increases in what willingness to people to pay for a share of earnings. Anyway, let's keep going. In other words, the total long-term return on stocks derived from dividend yields and earnings is virtually identical to the 7% real return actually provided by the stock market itself. All other factors combined have almost inconsequential impact on the returns provided by these two fundamental factors alone. There were, to be sure, significant variations around this norm. They were caused by the fluctuations in the valuations investors were willing to pay for a dollar of earnings, the PE ratio. So, courtesy of Occam's razor, I advance a simple theory. These variables determine stock market returns over the long term. 1, the dividend yield at the time of initial investment. That's it. 2, the subsequent rate of earnings growth. And 3, the change in the PE ratio during the period of time. And so that just means the change in PE, the ability of what some people say, how much they're willing to pay for dollar earnings. Sometimes it's more, sometimes it's less. All right, so we're going to look at Merck specifically. So check this out. So this is from Morris Deals, the House of Rockefeller, and we're going to share you some interesting information. Merck's, just going back to Merck, all right? So this has nothing to do with what his book is in terms of what we're talking about here, but it's very interesting because this is written in 1957 or something like that, 1958. So Merck's net income in 1957, net income means after taxes, was $23 million, all right? $23 million. So we take our trusty calculator and we're going to say, well, actually, first, hold on a second. Let me show you what I'm talking about. We're going to look at the net income for 2020. Net income was $7.067 billion for the annual. 7,067,000,000. That's $7 billion. We're going to make that future value. We got 23,094,000 million. We're going to make that present value. Not making any payments. And we got 1957 subtracted by, 2020 minus 1957. 2020, oops, 2020 minus 1957. So we're going to use 63 for N, because that's the number of years we're looking at. 63 and compute. Merck has averaged 9.5% a year increase in earnings from 1957. Oops, just earnings. 1957 to 2020. All right, Merck has averaged 9.5% a year. Now, I don't know how to find out what their stock performance has done since 1957. I'm sure it's in here somewhere. We don't need to take that time, because what we're going to do instead is we're going to go to 1985, and we're going to look at Merck. Is this Merck? Yeah, Merck. We're going to go to 1985. This is as far back as, actually, is this as far? Yeah, it's as far back as Portfolio Visualizer will go. So we're going to go to 1985. Yeah, we'll go to let's just go to 2020. So 1985, we put $100,000 in Merck, and we're going to see what the performance did. All right, so 1985 to 2020, Merck has averaged right there, 12.61%. All right, 12.61%. I'm already seeing something pretty phenomenal, actually. All right, so 1985 to 2020, Merck was averaging 12.61. That's what you would have returned on your money. All right, so then we got to find out what the dividend was in 1985, and I happen to do that. I can't remember if I got it here or not. I do. The dividend was, hold on a second, I had it here. Back to the Merck on the newspapers.com. It's actually pretty interesting. Merck says dividend, lots of great stuff in here. But I'm just going to use Yahoo, because Yahoo adjusted for splits and inflation and dividends. So basically, in 1985, it paid 2 cents. This will make sense here in just a second. 2 cents, 2 cents, 2 cents, 2 cents. So basically, it paid 8 cents per share, 8.3 cents per share on a share price that's been adjusted. Just remember that, 1985, we're going to go to historical prices, boink. It's been adjusted for inflation. We're just going to go back to 1985. We'll go to 1985, and we're going to go to 0, 1. There we go. We'll just do that, 1985. All right, so this has been adjusted. All right, so Merck is paying, and I've already done this, so I have a pretty good gauge. So adjusted for inflation, about 2.87. So adjusted for splits and dividends and whatnot. So we take point divided by 2.87. It's basically paying a 2.89% yield in 1985. I hope that makes sense. 2.89%. So basically what we did is we took the 0.083, divide that into the close in 1985, roughly $2.87. Again, adjusted for splits, adjusted for dividends and everything, and you're getting a 2.89% dividend yield. So basically taking the earnings growth year over year from 1957, all right, which is 9.5 plus the 2.89% dividend yield, 9.5 plus the 2.89% dividend yield. Holy schmokelies, what did we get for a total rate of return on a Portfolio Visualizer? 12.61. Earnings growth, 9.1 plus a dividend yield of 2.89, we get 12.39. So that means basically the full return gave us about 22 basis points, less than 0.25% more, just on a little bit of increase in PE ratios. That's it. Isn't that freaking crazy, man? All right, now you're saying, but Josh, that's not the net income. That's a net income from 2000 and from 2000. What did I say? The net income from 1957 to 2020. Okay, so let's write this down. So in 2020, net income for Merck was $7.06 billion. All right, let's find out what the net income was in 1985, shall we? We got it. So this is from the Danville News, Danville, Pennsylvania. But it's just all AP stuff. Imagine, it's from the. It gets submitted to every single newspaper out there. UPI, AP. And we see for the year, earnings per share increased. Well, we're at $7.58. All right, so earnings per share in 85 were 7.58, which is up from basically 6.8 in 1984. So in 1985, the EPS went up by 13%, the earnings, all right, net income. So total net income increased 10% to $539 million. All right, so now we're going to go back and we're going to use our trusty calculator, and we're going to say we take 539 million, and I haven't done this calculation. I could look like a fool. And we're going to use that as our net income in 1985. And we got, what's our 7.06 in 2020. So 1985, 20, let's see, 1 second. 2020 minus 1985, that is 35 years. So it gives us an N of 35 N, no payment. And we get an increase of income of 7.62. All right, so our growth of net income is 7.62 from 1985 until 2020. And 7.62, we had roughly a 3% dividend yield back then. So we got a 10.62% rate of return of what our expectations would be. And guess what? We actually ended up with 12.61. So we're off by about 200 basis points. You know why? Want to take a guess why? Actually, in Merck, to be perfectly honest, it's average about 4% dividend yield historically, 4%. So if we take the earnings growth year-over-year increase, which was 7.62 plus a 4% dividend yield, that's an 11.62% rate of return. We are, it's nuts, man. All right, so now what's Merck's price to earnings ratio? I think it's like 16 or something. Let's take a look. What's Merck's PE? I don't know off the top of my head. Let's take a look. Merck, MRK. Oops. Merck right now has a PE ratio of about 15. It's basically, it's been at right around 15 historically, sometimes a little bit higher, sometimes a little bit lower. But the reason why this is a little bit off, not much, but a little bit off, 12.61 to about 11.5, is because people are willing to pay a little bit more for a dollar of earnings than they were in 1985. And the reason is quite simple, my friends. Check this out. We're going to go to Treasury yields, Treasury daily yields, Treasury daily yield curve. So let's look at the interest rates in 1985 versus the interest rates now. I think it's this guy right here. Take a look here. Yeah. All right. So does it go back to 1985? I don't think it does. So here's a 10-year Treasury. Here's it right here. 1.92 on the 10-year Treasury. Interest rates are going way up, Josh. 1.82 to 1.92 over a month's time. Not a huge increase. Let's go back to I think it goes back to 1990. That's it. All right. So we just go back to 1990, and you're going to see the 10 years probably like a 5, if not 6. 7. Look at that. I mean, that's during the war, but still at the beginning of the breakout of the Gulf War. Let's go to 92 when stuff settled down a little bit. All right, there you go, still 6. So the point being is people are willing to pay more for a dollar of earnings now than they were back in 1985. And the reason is because the rates are so low. So that's an increase, like Bogle says, in people's willingness to pay more. Just, I hate to say speculate, but that's what you say. They're willing to pay more for a dollar of earnings simply because the alternatives are less. So, but you can't rely on that. You can rely on price increase in my wife just texted me, they're predicting turbulence on their plane. Increase in yields dividend yields year over year, and earnings growth year over year. That's it, man. Dividend yields plus earnings growth. That's how you get your stock performance. So you got to ask yourself, what is your dividend yield right now? It ain't much, 2%, and if you're expecting a 10% rate of return on your money, that means you have to have earnings growth of 8% year over year. Are you kidding me? You're not going to get that. I mean, you could. I mean, there's tons of different ways that could happen. But for anyone to sit there and say, we expect an 8% year-over-year dividend yield, even Jeremy Siegel's not going to say that. Freaking, what's his name? My boy, Brian Westbury. He's not going to say that. I just don't see how you're getting 10% a year. That's why I use a 6. 2%, 6.5%, 2% dividend yield plus 4.5% earnings growth year over year. I'm very comfortable with that. You use that for your stocks. Whatever the current rate is on treasuries is what you use for your bonds. So right now you got a, let's go right now, go to 2022, and we're getting what we said, 1.9 on the 10-year. Yeah, 1.9, basically getting 2% on bonds, 6.5 on stocks, man. 2% bonds, 6.5% on stocks. You take your trusty whiteboard. You say, I got 60% in stocks, 0.6 times 0.065. And I got 40% in bonds times 0.2. All right, so what we do, we have 60% in stocks, and those 60% we expect to get 6.5% rate of return. 40% on bonds, those 40% we expect to get 2% rates of return. So we take 0.4 times 0.02. That means on our bonds, we should get 0.008. And then we take 0.6 times 0.065, and we'll get 0.039 times plus 0.008. And we will get a 4.7% rate of return on a 60-40 portfolio, stocks and bonds. And that's not net of inflation. That's gross of inflation. So you take inflation out of the mix, you're going to get 1 to 2 to 1. 2%, 3% inflation. A 2% would give you 2.7. 3% inflation give you 1.7. And you still got to pay tax too. That's what you should prepare for. If you get better, that's great. But you should be, if you can run your numbers, that kind of preparation, you're looking good. If you can't, I would say you better think about some other way to make money or to reduce your expenses, or just got to keep working. Well, love to hear your thoughts. Hope this helps. Thanks now.